Okay, welcome everyone. We're going to get right into the stock market technical analysis. Today is Fed Day, so we got a couple things to cover. They're going to come out here in about an hour with their meeting minutes and talk about what their next action is going to be. So, potential market moving day today. Let's get right into it, guys. We'll start out with triple Qs. Now, the Fed is anticipated to hike. I think what's priced in right now is 75 basis points. But that was just a rumor, so it's not necessarily confirmed. The Fed has talked about only doing a 50 basis point hike. So I think that's kind of the pivot point, is if they come out with only a 50 basis point hike, the market might think that's bullish. If it's 75 basis points, that's kind of priced in. If it's more than that, then that should be pretty bearish for the market. So that's really it. You know, if you see maybe a percentage point hike, pretty bearish. I do think, again, I talked about this. I think we're coming down. Maybe this or one more hike is probably the last hike you're going to see from the Fed until they pause. I don't think they're going to start cutting, but it might be a pause. They might start to ease off their hawkish talk. And the reason why I'm seeing that is in the bond market. I'll show you guys that in a second. So levels that I'm watching on triple Qs, couple things. We've got a gap to fill overhead. All right, so that would be the upside level. We've actually got two gaps, so we need to mark those out. Gap at 288.44, and then we've got another gap here at about 299.32. So both of those levels are, those are kind of key levels and gaps to fill on the upside. Should act as resistance if we're going to trade up. To the downside, we have this potential bullish falling wedge pattern, and the bottom of it is coming down around 269.88. And then we also have some key support at 267.75, 268 we'll call it. So for me, there's definitely decent support down there. We might get a spike down, hit that support, and then rally from there. Again, when on Fed days, especially where the market's at, it's right now, it's kind of in between this gap up here and support down below. So it's really leaving everyone kind of guessing. So it's best usually to just kind of keep it light. And just let the price action dictate where we're going next. The one thing is, don't read too much into the initial reaction. So once the minutes come out, the algos just hit the market one way or the other, and it's not always going to be the actual move that takes place. So you got to give it a little bit of room. There's usually a lot of volatility on a Fed day, and so that's really what I see on that. Now, on the downside, if we're going to get a big move to the downside, which would ultimately be pretty much panic selling, then I see support, big support down here at the pre-COVID highs, which is 238. All right, that's the pre-COVID highs. This is basically before the Fed stepped in. The market was trading at this level, and then when COVID hit and we crashed, the Fed stepped in and pumped us way up. So maybe we could move all the way down to this area, 238. Not in one day. That would pretty much not be possible. But over the next series of, maybe to close out the week and next week, we could move, impulsively down. Something I want to point out on the NASDAQ futures, if you go to the weekly chart on NQ, this is basically the bull market price channel that the NASDAQ futures have been in since the bull market. And you can see that on the weekly, I've got lots of tags of support marked out. All right. And there's another one. There's another one there. There's another one. Okay. So I like that as a potential target, at least a near-term target. And then your pre-COVID highs are obviously right here. So big support right in this area. We might move down there, relatively quickly after the Fed minute. So if they hike more aggressively than expected, which is not very likely, it's kind of a low probability. I mean, this Fed doesn't like to surprise the market, but if they want to shock the market, then we could move down to this support level. That's likely going to be a buy zone. And so, yeah, that's kind of what I'm interested in right now, is maybe some more downside and then potentially a good area to go long for a pretty solid bear market rally. We're about halfway in between the top of the range right now here and the bottom. So we're just in the middle of the price channel. So who knows which way it's going to go after the Fed, whether we move up or down. It's really anybody's guess. But if we get down to that level, maybe there's some strong momentum. We could trade it down and then flip for a long trade for a solid bear market rally. Okay, gold. So here's gold bullion. We're just a little bit below the bull market price line. So here's the bull market I have on gold bullion coming from 2018. We've got lots of tags of support here, and just recently we're just slightly below. But again, we're going into a major interest rate Fed meeting, which is likely going to have implications on the dollar and gold and just the interest rates, obviously. And so we're still kind of hanging in there. The other thing is we're at a back test of that isometrical triangle right here. You can see there's the triangle. That was resistance, then we broke out, and we're kind of back testing it. There's back test 1, and we're coming in for back test 2. So nothing's technically really that bad. And then when I look at GLD has not broken the bull trend. So here's 2018, and you can see here's your bull trend here, and we're just slightly above it there. But also we have that back test here, and you can see there's back test 1 and back test 2. So gold's still hanging in there. Nothing really looks, technically broken. And also the other thing to look at is we did just make a divergent low. So this low yesterday was a little tiny new lower low, and yet we've got bullish divergence on the momentum. All right. So still looks good, still hanging in there, holding support, and, just coming in for a back test. I suspect, I don't know what happens today, because they could do a little flush down move, sell it down and then recover, or it could just rally. Today's a little bit up in the air, but if we can hold, maybe we flush down and then recover. That's one possibility, run a bunch of stops. But, in general, I'm thinking we hold in this area over the next few days and continue to rally. So this to me looks like a buy area, but, we need to get through today and see how things pan out. Barrick Gold, you can see on Barrick Gold, I've got a long-term trend line. This is your bull market coming off of 2015. We've got support. We've got 3 reactions, and there's a 4th right there. All right, 4 reactions on that trend line, and look where we're trading down to into this Fed meeting. Right down to support, all right? Coming into key support into the Fed meeting. It's actually dual support because it's major support there. And then also you've got this isometrical triangle that was resistance, all right? And we broke out from that, but we're coming into dual support right into a key Fed meeting. And the market loves to do this. They love to get you set up right on key pivot levels into major news events. So this is major support. We could drop a little, bit more down to about 1875, maybe even undercut it. Maybe they whip it down and then recover it. All right, if you see that, that would be bullish. And yeah, I'm expecting this to hold, but I don't know if it's going to break down and then recover. I don't exactly know how that plays out. The other thing is you've got bullish divergence right now, not fully confirmed, but it's definitely there on the RSI. And as I zoom in on the PPO, you can see there it is. So as long as we, hold here and maybe start to turn up, these bullish divergences will confirm. And yeah, we've got, we have bullish divergence, not confirmed, but it's definitely there. We're coming into major dual support. It's about it's about the best buy area you can make. So it doesn't mean it's going to work, but it makes sense. It's objective. If we go down just a little bit more to buy with a stop slightly below, you got to give it a little room for stop rates and stuff, especially today. But yeah, that's what I got on that one. Oil continues to sell off. I'm thinking we're going to continuing to break down. Here's CVX. Slightly breaking down. The oil futures, I've got a longer term trend line. This is the bull market that started in oil basically, and you've got support. This is a daily chart. So we could sell down to that trend line, and that's really where I think we're heading on the oil futures. I'm seeing stocks like DVN not getting a sell signal yet, but you have this big bearish rising wedge pattern, humongous negative divergence, that's been building for quite some time on both momentum indicators, telling me that we should break trend soon. We don't have a full sell signal. I've started to take some starting short positions in these ones. I do have a position in DVN. No sell signal though, so today it's hard to say what happens, but if we get that breakdown, then we should trade quite a bit lower on DVN. So my targets, I like this one right here. Obviously, you got the 200-day moving straight up, so you'll probably get a reaction there. But maybe right here at 45.65 would be a good level of support. Okay, but again, no break of trend, so we need to see that sell signal. And PANW still looking good for more downside. Again, we're playing off this bear flag. So you've got the flag pull, then here's the flag. We had the impulsive breakdown, a little bit of flagging action into the Fed. I suspect after the Fed comes out, we continue to break down. The target right now is right there, 374. That's our target. And I don't see any indication that that is not going to change, that we're not going to hit that target. So sticking with this one to the short side. And, again, I don't know which way the Fed, I don't know which way the market's going to trade today after the Fed, because things get really volatile and there's a lot of fake out moves. So we have to just continue to kind of let the price action be our guide, but not the initial price action. I'm thinking the Fed, we've seen a lot of, the market sold off pretty good so far. So the Fed, my interpretation is they don't want this market to crash. They want to walk the market down. That's kind of the continued thesis that we've been under. So, they want to walk the market down, then ease off, walk it down some more, ease off, and continue to put pressure on the inflationary pressures that are out there by walking the market down, but they don't want it to crash. So they're going to try to manage it from my perspective. And then let's look at the bonds. TLT, these have been continuing to sell off. Now we do have bullish divergence. It's been building for a little while. You can see right here on the bonds, there's your bullish divergence here and here. So we have a new divergent low. All right. Doesn't mean we can't go lower, but with the bullish divergence tells me that bonds might get bid up after the Fed. And then you look at interest rates, and this is what I talk about, where I don't think the Fed's going to be able to hike too much more. When I go to this TNX and I look at the weekly chart, interest rates are really starting to spike. This is the 40-year long downtrend in interest rates. So going back to 1981, we've been in this downward price channel. Interest rates have been continuing to fall, which has created stimulus for the stock market for 40 years, basically. And you can see the top of the channel, we're starting to break out to the upside. So things really start to break if you go too much higher too quickly. We're going to start to see actual breakdowns in the economy, failures of financial institutions, pension funds. There's going to be real breakdowns. Pension funds, if you think about it, a lot of the time they own a certain amount of bonds and they own a certain amount of stocks, and both have been falling this year. So they really can't sustain too much more without actually just breaking and collapsing. And the Fed doesn't want that. They're going to try to stop that in any way they can. So these interest rates spike high is with a divergent high. You'll see here we're making a new high in rates, higher high here, but lower momentum, all right? Slightly lower momentum. So we have negative divergence in interest rates. We have bullish divergence in the TLT and the bonds. Tells me that we're likely going to see interest rates come in a little bit and fall down. Now, I don't know if that's on a safety bid where people are selling the market and buying bonds. I don't exactly know, but we'll just let the price action be our guide. And that's all I have for today. I'm going to get this video out. Fed's coming out in a half hour. So guys, drop me a thumbs up and I'll see you guys after that. Bye.